You started out by, I apologize for I've got a frog in my throat. You started out by talking about the importance of information and insight.
Yeah.
And of course this bleeds into experience. And if you I don't know whether the questions or comments or both. For information, if information is really critical in making the right choices, then one would assume that specialization is going to be critical. And in specialization, you simultaneously pick up experience, some intuitive understanding. And if we look at this dichotomy between education and experience, to me, experience is also education. Let me explain what I mean. If I look at principles in physics, and we talk about angular momentum, that can explain why bicycles work and things of that nature. But because I read a physics chapter on angular momentum, doesn't mean I know how to ride a bike. I got to get on the bike, fall down a few times, and it's the tacit learning, the experience that allows me to get productive use of the so-called education coming from angular momentum. When we look at your field, what is it that people can do in order to maximize the tacit learning, the experiential learning, and to sort of make it a more regular feature of their own personal career growth?
Okay. So two questions there, both very interesting. Let's start with the specialisation. I think you're exactly right, and in a way I wish I'd built that into the talk, because when I first came into finance, people were pretty much generalists in terms of looking at companies. Nobody was really deep diving into industries and getting a real in-depth knowledge of how they worked. And that has certainly changed in the investment industry. And the notion that you can make technology investments, for example, without having some colleagues or a department or whatever, which really deep dives into how the technology works, etc., is of course ridiculous. So I think that's why I think you're seeing in the industry an economy of scale building in, because the factory that you need to do all this research is actually quite big. And the critical volume of assets under management, or I guess more relevant fees that you need to feed that, is very large. So that I think is why you're going to see consolidation in the industry, because you need that specialisation. That having been said, there is still a role for the experienced general fund manager in saying, I know you understand this very well, but you have missed a very fundamental point. Because people who are totally in love with the pharmaceutical industry will know exactly what a drug pipeline looks like, when this beta blocker comes off patent, etc., but they're so close to it that they can't see some of the other issues that might affect the pharmaceutical industry. And you get drawn into this sort of thought, because you spend so much time doing one thing, you can't think about it in a different way, try as you might. So I think you're exactly right. In terms of the information side, we live in the age of the specialist. There is no doubt about that. But the specialist can still be helped by the generalist in terms of somebody who's throwing out challenges, saying that I know you're in there thinking about that like that, but really I think you need to think about this in a different manner. So I think that's again where teamwork comes in. And some of the most successful organisations I see are where they have very detailed research departments, but some very experienced fund managers, and there is the chemistry between the two of the interchange of views.
So the experience is helping ask the right question,
exactly,
and question the assumptions behind the quant models.
Exactly. But the notion that I can go off and invest in certain areas such as technology without somebody who's got a really detailed knowledge of how these things work is laughable. Your second question, I think, was about how can you use the experience quickest in a way?
How can you become a sort of a learning model, so you learn how to learn, and that becomes your career.
think the one piece of advice I'd give to anybody who's setting off in the direction, it's about admitting your mistakes. You know, a sporting analogy: if you're trying to learn tennis, and every time the coach tells you something, you say, "Well, no, I did hit the ball right. It just bounced awkwardly." You know, of course I hit the ball right. No, your feet were in the wrong place. No, they're in the right place. The ball just bounced awkwardly. Look, there's a piece of gravel on the court there. You are not actually going to learn. You've got to say, no, I looked down at my feet. They're pointing that way. They should have been pointing that way. That's the way you become better at it. So anybody who is in denial of their mistakes, I don't think learns. The beautiful thing about investments is it's the only profession where you can make mistakes 45% of the time and still be a genius. I mean, you know, if a surgeon killed 45% of his patients, or 45% of flights crashed, I mean, it'd be a disaster. But in investments, 45% of the time you'll get it wrong. 55 all right, and you'll find that actually your funds are in the upper quartile. So you'll make plenty of mistakes. So it's not as if you have to wait a couple of years to have a mistake and then go, I better learn from this. Every day you're making mistakes and you can learn from that. The thing is not to be in denial, to admit that your feet were in the wrong place rather than say the ball bounced awkwardly. And from that you will learn. What did I miss from that? You know, I believe the management on this. If I'd actually looked at this aspect of the company, I could have known the management misleading me. I must be more cynical with management. You know? I thought I knew an awful lot about this stuff, but really I don't understand the underlying technology, and I should have gone to speak to the expert on that. So the good thing is there's plenty of opportunities to learn from your mistakes because of the whole nature of this. You buy a portfolio of 100 investments, if 55 work out and 45 don't, the customers are very happy because of the ones that do work out. So that's, if I think of something later in the meeting, I'll come back to you on that. But I do see, I know it sounds odd, but I do see an awful lot of people who every time they have a failure make an excuse from it, and what you know about them is they're not learning. And they are the most dangerous people to be let loose on money that you can imagine, because they're in denial of their mistakes. And that is a very, very big problem. And I would get back to, I know it's a bit of a hobby horse of mine, but read around the subject. There is a couple of hundred years of the history of industrial capitalism for you to look at what's happened and how things develop. And there's an awful lot you can learn from what's gone on. An awful lot. And, another question.
Question. For many of the graduates who are hoping to go into an area like fund management, they obviously do not have the experience, but they try very hard to choose the education they have. So they may go for MBA and so forth. Here in SMU, we have a great number of undergrads who pursue double majors and a significant number who pursue double degrees.
Mm-hmm.
So to just focus on the education part, if you were to combine 2 degrees, which two would you pick?
I think you can have too much of a good thing in terms of finance. And I think the problem is with people who've spent all their education in finance is that's the way they think and it's the only answer. I would be quite happy to take on somebody who had done something completely different and a finance degree. And I'm not just saying that because I have an economics and an engineering degree. Finance qualifications are very good, provided you realise it is not the entire answer. And I've had a lot of people with problems with people coming to join us who've got their nice shiny MBA, which they shows all the options that was to do with finance, and they won't be told. They know all the answers. And they produce these vast impractical models of the way things should be done, and you can't actually get through to them. So I don't think it actually matters, provided your brain has been stimulated, provided you have the basic elements of the financial models. There's plenty of time to learn on the job. Everybody who comes along will be made to do the CFA, which will involve further training and reiteration of this. So I think that what is more important is an open and inquiring mind when you arrive. If as a result of, if you've misused your education, like to close your mind that I now have all the answers because I've read these 4 finance textbooks and I'm going to go and conquer the world, then you will have a problem. So I think at the other extreme, I think somebody coming along who has no finance training whatsoever they have got a mountain to climb in catching up these days, because this industry has professionalised to a level that the happy amateur of 30 years ago would be out of place. I mean, 30 years ago you could show up with a degree in Greek and they wouldn't actually give you much formal on-the-job training. You'd just learn from other fund managers. That's gone. You know, that era is not there. But I don't think it means that you go completely to the other end, that somebody showing up just with a finance degree and believing they've got all the answers is necessarily going to be the answer either. As to which, I'm not a big enough expert in higher education to say which ones you should juxtapose. I think it's more about your attitude when you arrive as saying, I have part of the solution, and I'm now going to leave, you know, like your bicycle thing. I've got the theory of how this bicycle should work, but I've actually got to learn to ride the bicycle. That is probably more important in the success of your... and some people can be very stubborn in this. I particularly find it as an issue with some MBA students. They arrive thinking they know absolutely everything, and they know a lot, but they don't know everything. And that's a very big problem. Yeah. Well, anybody who in investment who thinks they know everything is a liability, because you know in investment that there are vast areas of ignorance, and it's actually trying to minimise those areas and risk adjust for the fact that you are making decisions with imperfect information is far more important. If you are insistent you know everything, you are a disaster with money. Absolute disaster with money. You have to be aware of your limitations. On that. Apologies if that offends anybody who's doing there's no disrespect to the qualification you're doing. It's how you use it afterwards. The qualification itself is very valuable. Another question, please.
Following up on the last question, what are the specific qualities and skill sets you look for when you are hiring a portfolio manager?
There are the obvious things that you would choose in looking for any job, so I won't waste your time with going through that. You know, people who are hard-working, etc., and smart. So what are the different qualifications that you are looking for in a fund manager? I would pick out two. One is, I think you have to be quite competitive. You have to want to win, and so somebody who's a very good player of games, whether it be sport or bridge, and actually wants to win, that really matters. I've seen a lot of people who've come from a university background who are actually quite academically detached, and they find it very interesting these stocks go up and down. But, you know, oh, I underperformed again. Never mind, that's interesting. But this is, you can't do that. This is a very, very competitive industry. You've got to want to feel at the end of the day you've scored more than the opposition. So, and whether that comes from being a very competitive tennis player or bridge or chess or whatever, you actually want to turn your academic knowledge, your ability into winning. That is very, very important, because this is a very competitive industry. Nobody has ever paid anybody gladly fees for underperforming, and that's the problem. I think the second thing is you've got to remember that we spend our lives with people trying to sell us things they don't want. I mean, very few of the stocks we buy are primary issues. We are buying a stock that somebody else doesn't want. That's why we're able to buy it. It's a finite amount of equity in issue. And if you spend your life with people trying to sell you things they don't want, you need a basic skepticism about life. And somebody who is wide-eyed and believing and believes the Wizard of Oz was a true story is actually very, very dangerous. The broker's on the phone giving them a story. Oh, this is great. How many can I buy? They are very, very dangerous. You need to be saying, why? So it's interesting. It's one of the reasons why so many very good fund managers actually don't succeed in management, because some of the characteristics you need in fund management, which is a sort of stubbornness and a cynicism, a pedantry, are actually very bad characteristics for managing people. If you listed all the things that make you good with people, they're actually all the things that actually make you bad at managing money. So what did the industry used to do for many years? It used to take all these people who were good at managing money and promote them to managing people, which was a disaster. Now the industry has got a bit smarter about that and has thought about the need to develop people before it moves them from one to the other. But it's a very odd set of characteristics you need to survive in this industry. And there are some very... I mean, if you meet a lot of top money managers, some of them are actually quite quirky people, quite awkward people, but in a way they need to be. Because say constantly, somebody is trying to sell them something they shouldn't buy. From the moment they get in at 7:30 in the morning, right through till the evening. And so those are two things I pull out. All the other characteristics of the stuff that I'm afraid you need for any professional, hard-working job, which I won't patronise you by running through all those. Does that help on that? No, but the competitive thing is very, very important. You've really got to want to outperform the market. You've really got to have a thirst for it, and a sense of disappointment if you don't. If you're I've had a number of people who've come along to join us from Oxford and Cambridge, very bright people, but they're very academic about it. It's all very interesting, isn't it? And it might be nice that it's interesting, but the customers want performance. Otherwise, there's no point in our organisation existing. Yeah. Please, the next other question. Anybody?
I have one more.
Yeah.
You talked about experience, and your two examples for why experience is important came from the comparison of railroads and the internet,
Yeah.
and from the comparison of brakes versus signal. If I look at the underlying content of all this is more strategy than it is finance. And
Oh, yeah.
and earlier on, a question was asked was, which discipline or which combination of disciplines our students might take?
Oh, right. So that's actually, sorry. Maybe therefore I misunderstood the question. That's a very,
No,
that's a very, very good.
yeah.
That's a very, very good point. Yes, I think anybody who believes that you can manage money just by financial models is wrong. The strategy is very, very important. So I now sort of understand better the question. I think, yes, you do need to marry those two together. I mean, in terms of one of our most successful fund managers is very big into its Porter's 5 forces and things surrounding model. And it's actually a very, very powerful framework to analyse it, because the numbers sort of tell you how it's working, but they don't tell you the opportunity set you're facing and how it will change. So no, I think if you are going to start out life, particularly as an analyst, and looking at an industry, you've got to have all the facts as to how the industry works. You've got to have the financial background, but you've got to have that ability to question the strategy and what will change and whether it's working. So no, I think that is very, very important. A lot of what we do is exactly as you say, applied strategy on that.
So may I be so bold as to interpret that as you have gone up your career ladder, and if I look at what you're responsible for now, it's strategy, customer acquisition, and talent management.
Yeah.
That what is important at your level, it's strategy, marketing, and HR.
Yeah. Yeah, basically, yes. that is exactly right. That is what I do for a living. But no, the strategy side is very, very important, and in some ways we are doing a job not dissimilar to management consultants. I shall now be tongue-in-cheek and say we're very honest about it, because we actually on the back of it make some decisions, whereas management consultants actually produce a very long document which is aimed at making sure that you retain them for another project afterwards. But no, the strategy bit is absolutely essential in terms of understanding that. You cannot manage money on finance alone. And I think that you raise a very good point here. I think when people look at our industry, they wrongly apportion the weights of the importance of these things. So finance is this much and strategy is this much, and it's probably almost the other way around. So the finance is important, but the strategy is probably more important in terms of that. And you know, the academic stuff, the education can help with the strategy at all, but so indeed can experience. And this pulls back to the interaction between the specialist and the generalist in fund management, because sometimes the generalist is good at asking the what-if questions in strategy. The specialist has got so used to how the industry actually works, the characteristics of the customer, the characteristics of the product, all the various forces, that they can't see the bit which is suddenly going to change. And I think that's where the generalist can be of huge value. But they can't do it on their own, because what they're doing is challenging a model. If there's no model to challenge, then they can't do it. So I think they're useful critics and sounding boards of this. and will often produce some good insight out of it, but you need some basic models before you can take that forward. And if I ever give this talk again, I shall work that thing in on strategy. I hadn't thought about it from that point of view.
You had made the point that in the way decisions are made, investment decisions are made, there was a time when it was the rock star sort of performer that made all the decisions, and your point was saying was that you really want to balance the people with the experience and the people with the education. So my simple question is, how does that happen in fund management companies? Because there is a hierarchy of decision makers, and like if you have a bull-headed person who makes all the decisions, he takes in all the information, but in the end calls it wrongly, despite all the advice and all the very balanced advice. Do fund management companies all operate differently in the way the decision making for investments are done? Or is it by committee, is it by persons, is it by teams?
A few observations. First of all, there are a million different models in terms of this. People are doing it in very, very different ways. Secondly, an awful lot of people are doing it very, very badly. This industry still has a lot of investment factories within fund management organisations that are dysfunctional, and not only are not generating value, but are unlikely to generate value. So I think in looking at what's being done out there, there is a best practice, school of best practice, but doing a wide slope of what people are doing, you find an awful lot of worst practice as well. And people are often quite poor about managing the HR aspects of this. I think that an increasing number of people are doing it properly, and it's not rocket science. It's about making sure that you do have the right balance within a team and truly asking the right HR questions. It's about a culture of ensuring there is respect, because without mutual respect, none of this works. But you use one very interesting word in there, committee. And while I talk about cooperation, let's get the word committee right out of this, because we've all sat on committees in various different functions in life, and committees can very often be lowest common denominator things, and success in asset management is not born of lowest common denominator. So the word committee, whether or not it is strictly true from the dictionary definition, but it has an overtone of compromise and what you can get past the committee. That is not how it works. You need something where you have the synthesis, you have the thesis and the antithesis, and it produces a higher synthesis. Unless you have a system that produces that, there is no point in people cooperating. If you get together and you have a dynamic where actually all you're going to let through is the things that everybody agrees on, by the time everybody agrees on them, they're probably not innovative. So you actually need cooperation, but not in a committee sense. People have to sit in a room, but they have to sit there not in that kind of way. They are trying to create value by throwing their ideas together and out of mutual respect evolving to the right solution, which is very, very different from for the committee at the golf club or whatever. And golf club committees would destroy serious value if they were let loose in the stock market. So I think that is a very important point I'd make. But there's no rocket science here. It's just basic HR management. But it has to be said that until the last 10 years, the investment management industry was not very good at HR management. Not very good at handling it. There's one other point you made in there about the dominant personality, and one of the great challenges in managing an investment company is to use the dominant personality correctly, because they will have strong ideas, which is good, but if they shout down everybody else's ideas, it is very, very dangerous. And we had a former employee who actually was net a very good employee, but one of his problems was he was so frighteningly intellectual that if anybody had an idea and he didn't like it, he would shout them down before they could even develop it. And that was a big problem for us, and we had to overcome that. I think the strength, a measure of a sound intellect is somebody who's prepared to listen to an idea that opposes them because they're not frightened of it. Often people shout ideas down because they're actually frightened of them.
In your investing career, what's been your biggest mistake and what did you learn?
So I am probably more bullish than I should have been. So my mistakes have probably been more around a level of optimism when there should have been pessimism. So I think my biggest mistakes have probably been when I have known that markets go down and I've positioned my portfolios accordingly, but not enough, because I thought, well, there will be a correction in markets. And I should have listened to history more. When things go wrong, markets don't go down 10, 15, 20%, they go down 40%. And at that point, your higher beta investments, your risky investments get absolutely punished and you've got to get out of them. So I think my biggest mistakes would be in times of market correction when I've taken action but far too little action. And I need to build that in. So what I try and do now is talk to a few pessimists. Because you've got to share different views, because I start from a naturally optimistic view of the world. I give you an example of that recently. I wouldn't say it's my biggest mistake. I am very, very bullish on what's going on in Asia. My own personal investment, I've got an awful lot of money here. I should have told myself, if the markets are going down, Asia always goes down as well. It cannot buck the trend. Now, I know that, but unfortunately there's a side of my brain that believes in this so much it can't bear to sell the investments. And I need to overcome that side of my brain with this logical side of the brain. So I think the nature of the mistakes I make, I now know. So I have to talk to pessimists, I have to talk to people that don't believe in it, and make sure that I'm not filtering out that data. But say the nature of the mistakes we make is often a function of our own experience, and I am a child of the bull market. Mercifully, which made my career much easier.
Sorry, I couldn't resist. Having made that comment, if I may just share that a memorable saying from the last president of the NUS, Shi Chun-fong. He said, "I've never met a successful person who's a pessimist."
Well, it's true. I think if you are, particularly if you're going to work on the equities side of this business, if you are somebody who naturally believes everything will go wrong and capitalism doesn't work, you should probably choose another career, which is going into bonds, because successful bond people are generally pessimists. So the optimists of the room go over that side and do equities, and the pessimists of the room go over that side and do fixed income. There's a very different psychology in the two, but I think you're right. It is very difficult to work in what is effectively capitalism without being an optimist. Very difficult. I think we've used up our time a lot, haven't we? Thank you very much for your attention. I'm very, very grateful.